We get the question a lot. Why do we purchase properties and hold on to them for 3 to 5 years and lock up my money between 3 and 5 years before I can get it back? Now, the way that we see this is that we are strategically positioning our investors' capital to be able to give the highest likelihood of actually growing. And John and I, in today's episode, are going to be breaking down the main reasons why it is a competitive and a strategic advantage to be able to be in an investment for at least 3 to 5 years. John, it's great to be here with you.
So good to be here, Mark. It's interesting because, right, in the public markets, you get that ability to get to liquidity, right? If you decide you need some cash, you can sell some stock. But the reality is that the stock investors that do the best are the ones that buy great companies and keep it in the company a long time, right? They don't get worried about the dips and the cycles, right? And they just kind of keep invested in. You look at like that kind of S&P 500 or the any of the different indexes, and it's just really about that time and market, right? So really in private real estate, it's time that drives both cash flow and equity growth, right? So looking forward to diving into this topic today.
Yeah. And if you are looking for a real estate investment and you're busy, you can't find deals, maybe you're a Canadian and you're thinking about buying down in the US and it's hard. It's hard. You're working full time. Maybe you're running a business. Maybe you're a professional that you're working full time, and you're flying down south and you're looking at properties, and then you got to build the team, and you realize, man, that this is just so much work. Go to fulloutinvesting.com and check out our full out investing process. And so this will actually give you a full breakdown of what it would actually look like to come in and partner with us and get equity in our deals. And so you'll be able to find that at fulloutinvesting.com, but definitely go check it out. So getting back to the show here, John, yes, the 3 to 5 year time frame in regards to looking at it as a competitive advantage, because yeah, a lot of people are used to liquidity, in the markets, and they're investing into a real estate fund and they can get access to the capital. And so at the beginning, there's that question does come up, but as our investors start to see how our deals are operating, they're like, oh, this is really good. Wow, this is really nice. We have people that are doing all the work and they're getting the monthly updates with all of the rental increases and then all the work that we're doing. And we package it up and we go over any of the challenges that we're facing as well. But it's interesting how the question comes up at the beginning, but then when the investment is actually happening and as the business plan is unfolding, everything starts to make sense for our investors, and they're like, okay, that this makes a lot of sense now.
That's right. It's kind of like good things come to those who wait, right? Having a little bit more of a patient approach here, it allows us to execute on our business plan. And what we're going to do today is actually really break it down almost year by year and kind of what happens in each year and why that time is necessary to achieve those, sort of above market exceptional returns that we're targeting. But yeah, it's really, once again, I mentioned it earlier, it's that time, right? Because what we're also getting is just the natural appreciation that occurs with real estate and then the forced appreciation we create through execution of our business plan. So allowing that time to occur. And then it also allows us to, offset any potential, kind of microeconomic or macroeconomic
Yeah.
downturns, right? If there's a
Mhm.
recession or something like that. I mean, one thing and one reason we love these deals, Mark, and we've mentioned this on many of our podcasts, but rent does tend to rise alongside inflation. And there's only been one time, which was the Great Depression in the United States, where rental rates drop, right? So we know rent will continue to rise. But, let's just say in year three, there's an economic downturn. We can kind of keep the property stabilized, keep that cash flow coming in, and then exit when we think the market is primed for that, sort of like, ideal sales price, right? That will return that capital to our investors with the equity growth they're looking for. So it is a bit of a patient process, but one that does deliver, in my mind, some of the best returns you can get in the investment market.
Yeah, for sure. And as we're going to go through the 5 year hold and what we do every year, just think about that. If you're investing in a real estate fund, okay, and you can get access to capital at any time, think about how the structure of the deal actually would work. And so if everybody has liquidity or has the option that is investing in that, we'll call it a REIT or a real estate fund where you can get, redemption periods are like 30, 60, 90 days. The reality is that they're constantly raising funds. They're constantly raising funds, which means they need to have more funds than they're actually utilizing, which waters down the returns. And so this is where, as an investor, I want to make sure that all the dollars that are going into a project are being utilized, still to have some reserves, but you're not over raising just for the sake of liquidity. And so this is one of the things that when you're investing in something, you got to just think through that process. Is if they're allowing everybody the access to those funds, then you got to think like, well, where are they going to be getting these funds from if everybody goes in and redeems their shares?
That's
And
right.
so this is like a big thing. And that's where for us, it's like every dollar is accounted for. And as soon as the full capital raise is finished and raised, then we close it out and we allow that deal to run. And this gives the highest upside in these deals to be able to do its work, and it makes those dollars like think of them as little soldiers, right? And those soldiers are making big impact. But if you keep on raising funds and you have more soldiers in there to go do the same job, that means that all those soldiers are going to be getting a little bit less return, if that makes sense.
No, it does for sure. And the reality too is that often with these funds that have that redemption option, there's also some clauses that they can pause those, right? And so there was some
Yeah,
headlines, right after the pandemic when interest rates started going up, where some of the biggest institutional funds were freezing those, right? And so all of a sudden that capital isn't as liquid as you once thought. And now you may be invested in a problematic deal because these guys are investing in, in some cases 10, 20, 30, hundreds of deals in these funds, and so now you're locked up and you thought you had that liquidity. So, it's just one of those things that, for us, I think what we really like, and I know our investors appreciate, is they're literally choosing the asset they're investing in. They're not just giving us money and hoping
yeah,
that we make a good decision. So they really like the deal. They can invest directly in that deal. Now, Mark, as you know, I think we've had maybe a handful of investors that have actually walked on the property. And usually that's because they're in town on a vacation and they have in the area. And we love giving those VIP tours. We're always willing to do them. But more often than not, they review the pro forma, they review our deal deck and all of our materials, and they can make an educated decision, do their own research, but they know exactly what they're investing in. So I think that's another factor here. But that 5-year plan, right? It sounds like a long time, but what I found is, time moves pretty quickly. And, what we're doing really is, kind of renovating, flipping a house on steroids, right? Like we're doing an entire building, hundreds of units in certain cases. And so that year one, right, it's all about getting the property stabilized and starting that improvement process. So we touched on our 28-day transformation in the past, but that is such a critical component with what we do because that helps stabilize, right? Because that's the important factor in year one. So often we're taking over an asset where maybe the property management team that's currently in place hasn't been doing a great job. So maybe there's some bad reviews online, some deferred maintenance, and things that are really detracting from a property in such a way that it's keeping the rents compressed. So we love that because we can come in and fix that very quickly. So when we execute on our 28-day transformation, yes, we're first and foremost taking care of the amenities, making the exterior look great and showing value to the residents, but we're really almost more importantly installing our culture, right? That resident experience that's so important and top of mind that I would say, frankly, a lot of investors, or I should say operators, are less thoughtful about, right? And so making sure that the residents feel the love, they hear about our 3 guarantees, and that culture has such a good impact because I look at our Largo property as an example, our Strawberry Station, where we're just crushing our pro forma and just outperforming. It's because the residents felt that value and they feel that culture of love, and we're making wise choices, we're providing first class service, excellent operations, and we're moving quickly, and so they're willing to accept those rent increases, right? So in that year one, it's all about starting immediately on those unit renovations. Now, generally in a typical deal, because we want to keep occupancy stabilized, right? We're not throwing people out to renovate. We're doing it thoughtfully over time. So, 4 or 5 units a month. We have to address that deferred maintenance. So that may include replacing some roofs or, some of the major systems. But often it's just the small things, pressure washing, painting, new hardware, new lighting, and things like that, that just improve the overall quality of the asset. because we buy deals that cash flow on day one, we're also optimizing that, trying to see where we can save on expenses and increase NOI immediately. A lot of that comes through those unit renovations, of course, but can it be done in other ways where we're looking for additional and other income opportunities, like, for example, valet trash or a washer and dryer rental program, or maybe building out some storage units. So we're getting that CapEx dollars immediately working to force that appreciation and to drive additional NOI. So year one is all about that stabilization process and starting our business plan in earnest.
Yeah, right on. It's laying the foundation, right? Year
That's right.
one is like first 28 days, bam, like we're making an impact because we knew this and know this when we hire somebody that first day that somebody comes on board, that if you make a real impact and you have a high bar for them to set, they're probably going to keep they're going to keep showing up at that rate, at that higher, we'll call it the accountability standard, right? And
Hmm.
that's where for us, when we're going in within the first 28 days, it's not like we're coming in and saying, yeah, we're going to do all this work. It's like, no, we're going to show you. And then after, we're going to talk about it. We're going to
That's
show
right.
you, add value, and then talk about it. So we do that in the first 4 weeks. And then the rest of the first year, John, as you know, the cash flow it's still decent because these properties will cash flow from day one, but it's laying the foundation. That's really what we're doing in year one. And then that jumps to year two and three, and it's more of the same, right? And this is where a lot of operators start to get bored. It's like the monotonous, okay, you got the odd tenant or resident that's giving you some challenges, and it's like, oh, I got to deal with them again. And like, this is where the growth is really happening, is just below the surface in year 2 to 3. And John, one of the best kind of examples that when I think of real estate, I think of bamboo. Now
Hmm.
bamboo, how it grows is the first like 3 years, it's just setting its roots. So there's no sort of like nothing's coming above the ground, it's growing under the ground for the first like 2 to 3 years. And then once it shoots up, bamboo, like it can grow 3 feet a day. And and this is what real estate is not sexy for the first 2 to 3 years, and going through the business plan and doing the renovations and basically executing, it's not easy. It's
Yeah.
okay to do it for the first few months, but then over a period of 2 to 3 years is tough. But that's where you're laying the foundation and you're continuing to, we'll say, grow roots in the real estate asset. And then that brings us to year 4 and 5, which I'm going to pass that back to you.
Yeah, yeah. So kind of just kind of real quick on year two and three, we're still renovating, but we like to think of that as like we're really harvesting cash flow, right? So that's where we're really deeply ingrained in the property now. That foundation's been set. So often we can unlock more savings. And maybe that could look like we acquire an asset nearby and we can share some expenses across those and reduce the NOI that way, renegotiate contract with vendors, but we're also continuing to renovate those properties. So in year four, it's really about value unlock, right? So there's some options that are available, right? Right now, rates are higher than they have been historically over the past 10 or 12 years. And so we always get fixed rate debt. So these deals work at its current debt and will work all the way through the hold period without the refinance. But if rates were to improve in, say, year four, we have the option of a potential refinance where we can cash out, return some of that investor equity back to those investors, and keep the property flowing with increased cash flow. Because ultimately, if we get better debt terms, our cost of capital drops and investors win there. But that is an option, right? We don't always do that. In some cases, it may be, frankly, in year four, there's an opportunity to exit because the market has improved in such a way and we feel that that's there. I mean, at the end of the day, Mark, I know you and I have a lot of conversations. When we feel we can maximize those returns for our investors, that's when we're going to act. We're not going to wait that whole 5 years out, but we have that if we need it. So it's really about that value unlock. And often that can also be done without the refinance, just by continuing to improve the asset, looking for opportunities to add additional income. And because of our culture, Mark, we're seeing above average, above market organic rent increases, right? So, sometimes you'll look at some data and it'll say, well, we're anticipating rent will increase 2% a year over the next 5 years, but we're often getting 5, 6, and 7% on our organic. And when we say organic rent lift, what we're saying is on renewals, right? So residents already in there, they're happy, they come for their renewal, and we get that rent up to market value. And so if you're not taking really great care of the residents and you try to raise their rent, they're going to tell you to pound sand. They'll go down the street and get a new property. I mean, you shared that example where, the guy who was cutting your hair just couldn't get his toilet fixed, and after 10 years moved because he was just so frustrated, right? So that's where the guarantees come in and all the other things we've talked about related to the resident experience. Year 5 is really that strategic exit period, right? So that's about looking at market timing, the maturity of what we've been able to create. Is our NOI on target, and what are the going cap rates in the market at that time? So, really in year 3 and 4, we're talking with brokers. We're starting to get some of those opinions of value. So we're not just waiting for year 5 to see what happens, right? We're starting those conversations early and often with those trusted brokers. So when we feel like we're at that right time, we can go to market and exit that investment ultimately. What's so great though, Mark, we've touched on this so often, but along the way, you're getting return of capital in cash distributions. And then because of the way we're deploying the CapEx dollars, that renovation budget, often that's even being offset further by that capital that's being spent to improve, that could be leveraged as a tax write-off. So, I think for me, the more I realize the true power of these investments where I'm getting some mailbox money, I think you call it milk money on a monthly basis. And then you get these above average returns at the end, just make these such a unique and interesting opportunity that every investor should be looking at. And it just really goes back to, once again, we're investing in a core human need here. Everybody needs shelter. And in both Canada and the US, we have a major housing shortage. And I don't really see any opportunity for that to improve in the coming future. I mean, I truly don't. Materials costs keep rising, land costs keep rising, debt costs keep rising. And so, for example, Mark, this is a stat that is held since 2022 in the United States. 30% of single family homes in the United States over the past few years have sold to investors. So even the for sale stock of single family homes is being gobbled up for rental. And, a lot of people want to point at the big institutional groups like Blackstone and America Homes for Rent that are out there, but they're like a small percentage of it. A lot of these are mom and pop investors that are buying these properties. So it's just going to drive more and more people to rent. And it's why we're betting so big on multifamily real estate.
Yeah, 100%. And so, this is interesting. You see a guy like Warren Buffett, one of the best investors ever, right? And one of his, core ideas is he invests in companies that he knows really well and is very good value, and he buys them and he holds on to them.
Yeah.
He's not like this big stock picker where it's like one day in, one day out. It's like he buys them, undervalued companies, and he buys and holds on to them. And
Yeah.
it's very simple. And he said, "Listen, if you're not a professional at analyzing companies, just buy the S&P, buy the overall index,
Yeah.
and just hold and wait." He's like, "You're
Yeah.
going to be like, was it 80% of the fund managers out there?" And so, real estate has a very similar philosophy in the sense that when you buy a really good asset, and you buy it in an excellent location, and John, we'll do a whole episode on finding market, the right markets that are about to boom. And this is where we do deep underwriting and deep analysis and research to make sure that the properties we're buying in are in excellent location. But when you buy a really great asset that's undervalued, you want to hold on to it long enough to be able to get as much fruit as you can
Yeah.
from that. And so that's where I would just say is a big thing. The other thing that's really that's important here is that if there is something that comes up, let's just say there's some market uncertainty and then the headlines come out and it's scary. What happens majority of times, and you see, say, the market, let's use that as an example. Scary headlines come out and the market drops by 10, 20, 30%. Well, most investors rush in and sell
Yeah.
and they lock in the loss. And so with the 3 to 5 year time frame that we hold on to our assets for, not only are we executing the business plans we talked about, but it actually is protecting the investors from all of ourselves, right? Because at the end of the day, human fear is like, okay, I gotta do something. I gotta sell it. I gotta grab onto it before it goes to zero. And so with these longer time commitments, what that does is it allows you to still get your cash flow, but allows you to weather any storms. And the other thing is you're not looking at your phone every single day. Did the stock go up? Did it
Yeah.
go down? Like, you know what I'm talking about? It's like,
Oh, I
"Oh,
know
I
it.
just
Yeah.
lost $20,000 today." Like, how does that make you feel? Like, I
Yeah.
don't know if that helps add joy to your
No.
life, right? Versus,
No.
okay, I'm getting my
Yeah.
monthly update now, and I got, holy geez, we got like 10 leases that all signed at $300 or $200 above what they were in the past. Like that's wonderful. So that the roller coaster side of it is a real thing, which is, one of the reasons why I love real estate so much.
Yeah, and going back to Warren Buffett, right? He likes companies with a moat, right? And by that, just has something that's defensible, whether it's like Coca-Cola. I mean, it was interesting. Even when they acquired a big ownership percentage in Dairy Queen, people kind of laughed at him, but he's like, Dairy Queen is like a institutional, iconic brand in the United States. So if we can get in there and help them kind of tighten up some things, and it's turned out to be an incredible investment. So the point is that when you pick the right asset in the right market, effectively that's a moat because it's something that will always have demand. And so when the right metrics are in place in that market, like population growth, economic diversity, good rent to income ratios, and a lower amount or no new supply coming on the market, that almost in and of itself is a moat. But it's interesting, Mark, because we were talking about the public markets, right? And that I think it was Tony Robbins that talks about in terms of human motivation that fear of loss is a greater motivator for most people than that potential for gain. And I was just having a quarterly check-in with my financial planner now. In January, I called her and I said, "Look, with this new administration, he's talking about some big, bold ideas. So I'm worried about a little turbulence in the market." And she talked me off the ledge and just said, "John, you're invested in really great companies. We're very for your age, you're already pretty conservative. Just hold tight." Well, then that tariff announcement hit, stock market plummeted. And she called me and she was thinking I was going to be all mad at her. And I said, this too shall pass. Right. And so my point is, I didn't do anything. I didn't sell anything. I didn't panic. And now I'm about 15% up from where I was the day, before the tariff announcements. And so just by staying in the market, things course corrected. But how many people panicked and sold? And then guess what they did? They probably bought on the upswing. And so they're way worse for wear than if they had just held the line and stayed invested. And so that it speaks going back to, yes, these other investment opportunities have liquidity, but is it smart to sell when there's just a little bit of a temporary blip? And the reality is it's not, but many do. So I think that's also something we think about. So, kind of that 5-year timeline, right? It gives us enough time to complete the renovations and lease up without rushing. So we could be more thoughtful. So if we're starting to see that, maybe something's happening in year 2, we can slow the pace of renovations for a little bit and just work on our organic rent lift and then restart renovations when the timing's right. Or if materials costs temporarily increase, we can make adjustments to the plan. We avoid that short-term market noise, right? Like once again, the headlines, that you mentioned where you're checking
Yeah.
your investments or you're going into your stocks app on your iPad, iPhone or whatever. That tax efficiency that comes with long-term capital gains versus short-term, right? That's a huge one. And we're also maximizing that IRR, right? That, a lot of our investors think more in AAR, that average annual return, but IRR is very important. It's, over time, the value of money goes down. So we're maximizing our IRR. And, frankly, this is just how it works with these deals, lender and buyer expectations, industry standard timelines. So, it's really just something that I think is worthy of some consideration. And number one, to diversify if you're more invested in public markets, or number two, if maybe you're doing it on your own, right, a little bit and dealing with some of the stress and headaches that can come from owning rental property. That bad resident that gets in there and doesn't pay rent or trashes the unit. That scale that these multifamily affords is so beautiful because we're buying 114 units and one person stops paying their rent. It's like a blip. But if you own one rental property and they stop paying rent, it could destroy your returns, right? So that scale is something super critical here investors need to be thinking about.
Yeah, and another thought here, John, as well, is that with a risk, that's a real question that we get asked a lot, just like with any investment, what's the risk in it and how do you mitigate risk? And so one of the things is when you look at if you are, say, building a large apartment, you're building a community, you're building anything, the reality is that costs and material costs can go up by the time, sometimes these projects, they're a year or two out or 3 years sometimes, and projecting what material costs are. But if you're doing a big overhaul building, I mean, that's a lot of material you got to order. And just like if you were going in on a 100-unit building and you're doing all the renovations all at once. And John, we saw one group actually that actually went 50% down. They leased down like 200 units,
Yeah.
they, down to like, I think down to 100. And then the idea was to like lease them up very quick. But then they broke their agreement with their the mortgage company, and all of a sudden, because they're under their debt service coverage ratio, they ended up going into into
Foreclosure.
foreclosure.
Yeah.
But the point there is that if you go in and you have to renovate all those units at once, there's more risk with, say, cost potentially going up at that time. There's more risk with the GC walking out in the middle of the project, and all of a sudden you got 100 units, versus if you do it over a period of, say, 2 to 3 years. The beauty with that is if you do have a blip, say a GC gets up and just walks out on you, or material costs goes up, and it's like you're already halfway through renovation, and you have to do the renovation at that point. And it just lowers risk again when you're doing it over a slower period than doing it all at once as well. So it actually helps mitigate risk from an overall like cost standpoint when it comes down to materials and how we renovate these units.
That's right. Yeah, that rush renovation to me equals poor
Yeah,
execution, right? To your
that's right.
point, because
That's
in
good.
that example you gave, they
Yeah.
leased down, and then all of a sudden they realized renovating 100 units at the same time was, they bit off more than they can chew. They got in a big dispute with their GC, and before you know it, they're in foreclosure. And so that more patient, methodical approach leads to higher quality and, frankly, higher resident satisfaction, because that's another factor we have to consider, is disruption to the current residents, right? If it's a construction zone for a year and a half, people are going to move, right? And so when we execute even on our 28-day, like, we obviously are in a sense disrupting, like we're replacing hardware on people's doors, so we need access to units. And so we just try to be as thoughtful as possible about that. But the main thing is that's where we move very quickly. But then when it comes to the unit renovations, it's quality, consistently done over time. And yeah, it's to me, it's actually, in a sense, the risk mitigation is just in the 5-year hold, right? Because it gives us
Yeah.
options. If there are challenges that are unforeseen, or if some material cost rises, we can slow down until things right size again. And we get that cash flow in. And when we talk about liquidity, right, let's talk about it. Like, we're giving out monthly cash flow distributions. They generally start in the first 3 to 4 months. We catch you up back to day one. And so you're getting return of capital, which is better, from a tax perspective. And we're deploying your capital strategically over time to drive that growth in income. And frankly, if liquidity is your top concern, maybe this isn't the right asset class for you. But I will say it is the best wealth building asset class for you. So if you're interested in building wealth, then take that more patient approach.
Yeah, 100%. And we get the question a lot. It's like, well, what happens if I need the capital, like during the hold period? And like it's a question that comes up. And so the answer to the question is the equity is being deployed and it's working right now. And so the thing is if we start deploying and cutting checks, personally to get our investors out, we didn't factor that into the overall returns of over raising for it and having, we'll call it, an extra slush fund to be able to cut checks to investors that need liquidity, for whatever reason. Can be personal, can be whatever. We are committed to maximizing returns for our investors. That's the mission.
Yeah.
And so that's where we go all in on that. And
Mm.
so yeah, the distributions start within 3 to 4 months, as you said, John. So the monthly distributions are coming out. So that's consistent. That's something we commit to. That's something that we factor in, and we have a reserve fund there as well for any sort of scenarios that could come up. But in regards to cutting checks during the hold period, they're working, and so we let our investors know that up front. And if something does come up, then that's not a possibility. And you said it, this is not the right fit for people that want instant cash. So they want instant liquidity, and so this is where it's all about wealth building,
Yeah.
like you'd said, John. If you're committed to building wealth, we'll call this the ultimate wealth building machine, is what we'll
Yeah.
call it.
That's right. Yeah, and just to kind of get a little peek behind the curtain. I mean, in Canada, we work with these exempt market dealers, and so they're looking at your overall financial portfolio. And so they'll recognize when this isn't the right fit, right? In other words, it's going to just be in the numbers, right? And so that's where there's, that accredited investor, right? And we have the same down here in the States, but it's a certain amount of income or a certain amount of liquid net worth. So, once again, this is just something you'll have to kind of think about internally and understand that, like, coming into these, there is that ability to, exit early is not available, right? So if that's just something that is going to be important to you or something that's top of mind for you, this may not be the right fit today, and that's okay. Maybe in the future
Yeah,
is the right fit,
exactly.
right?
Yeah.
So it's just, for us, it's about finding the investors that understand what we're doing, and they understand that 5 years allows us to execute on the business plan, maximize cash flow, and maximize our exit value. And I would say that, another thing to consider, shorter holds often mean missed potential, right? Or a forced sale or something, right? That, like, where maybe the timing's not right. So our hold period is really a strategic decision, not a barrier. It's a benefit. So one thing, Mark, you mentioned at the top here, but just to reiterate, fulloutinvesting.com is an incredible resource. And actually, every day we're thinking about ways to improve it. So please go there. You can get a sample deal. You can actually learn more about our full out investing process and book a time to talk with us. And just to be very clear, when you book that time in, it's not a sales call. It's just, we want to get to know you. We want to learn about your goals. We want to hear what you've been going through, what, in a sense, pain you've been having maybe in the market and your investments, and maybe just see if there's alignment. So it's really low pressure. It's just about getting to know each other and learning to see if we're the right fit for each other, because, some investors aren't the right fit for us, right? Just the same as maybe our investments aren't the right fit for you. So it's really about strategically aligning ourselves with the investors that understand this and are really excited about what we're doing.
Yeah, 100%. And those discovery calls, John, they're gold because it allows investors to, see if it's a right fit. And we look at it from our point of view: is it a good partner to be able, to be working together for 3 to 5 years in the commitment. And so we're seeing more and more investors saying, you know what, I want to get out of the system. I want to get out of, getting these 5% returned. I want to get out of, getting, stocks where, like, you got the GameStop movies that are coming where they're coming. You got random people
Yeah.
coming in and scooping out and manipulating the markets. They want real, they want tangible, they want something physical, and they want somebody that they can trust, that's actually going to go full out for them, is going to speak truth to them, and is going to be able to, follow through on the execution side long term. So like a 3 to 5 year hold period. And more and more investors today, they're busy running their businesses. They're professionals, the lawyers, the doctors, the engineers. They're busy,
Yeah.
busier than ever, and they may have one or two investment properties, and they're tired of, the tenant late night phone calls, and they're tired of managing it, and time is more valuable. So definitely schedule that discovery call with us, see if it's the right fit. And we'd let people know, listen, this doesn't sound like it's the right fit, but here's actually another potential that could be a good thing for you. And we tell people that up front, and we want to be of value for anybody that wants to schedule a call. So definitely schedule that in. You can click on the link below and scheduling that one-on-one. But really, thank you guys for listening and following the show here as well. And if you do like it, you can go ahead and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.